Hello everyone and welcome to another one of our Macro Mondays. We're on to episode 11 now and there's lots to talk about. And first of all, we'll start with the new narrative that has very much taken hold of a Goldilocks situation for the US. Not too much inflation, strong enough labour market, everything looks good. So markets are pricing in good times and we're getting a lot of commentating and many price targets now moving into the 6,000 on the S&P 500, which is a historical high in terms of a price to earnings ratio. So from a value perspective, there have been very few times in history where the markets have been pricing in such a rosy situation or at such a expensive multiple. But anyway, let's go into why the Goldilocks situation is arising, or the expectation of it is moving into markets and into the mouths of commentators. So one being that now the Fed has started to lower rates. This has an expectation to make the monetary system less restrictive and therefore promote economic growth and save the labor market. Now, CPI in September was at 3.15, PPI down to 1.44 now, and obviously the Fed funds rate is at 5. So that's where we're at with inflation. Now, on Friday, we had a huge beat, almost double what the market was expecting in terms of job numbers. So we had 254,000 new jobs added in September. This is a preliminary number. However, as it stands, 254,000 new jobs added in September, which is a massive number, especially compared to expectations. What we would note, though, is when looking into the numbers, there's quite a lot of concentration in a few sectors of employment, specifically government, private education and health services, and leisure and hospitality. And over the last 12 months, August 2023 to August 2024, 73.51% again came in from government, private education and health services, and then leisure and hospitality, with the large majority coming in from private education and health services. And if you looked into those numbers specifically, there is a skew towards the health services. You know, what do we think about this? Perhaps it has something to do with the large amount of immigration, which has led to more teachers, nurses, and other people needing to be hired in the market. And then when you look at leisure and hospitality, how many of these new jobs being added are one person? Because these job numbers are for one job, but one person could have multiple jobs, especially in leisure and hospitality. So what do we think about this? I think a way to think about this is perhaps, where's the rest of the economy and the employers, the private employers? Where are they, and why is there such a lack of demand in the kind of private employer space? Manufacturing, retail, construction. Construction's actually been quite good. Financial services, technology, etc. So at this moment in time, it seems like there's a lot of concentration, and these aren't the best jobs in the world in terms of gauging whether the economy is firing on all cylinders. Now, this one really stuck out to me when, in my opinion, the greatest investor of all time, Stanley Druckenmiller, says that he's got 15 to 20% of his portfolio short bonds. I think it's worth taking a listen at the very least. And the commentary there from him at a conference was basically bipartisan fiscal irresponsibility is going to lead to bad things, although I guess he said that he didn't know the time frame on that. However, he is short about 15 to 20% of his portfolio value against bonds, which, if you think that rates are coming down sharply, that would be a very concerning trade to take, because in theory, bonds would basically rally extremely hard if rates came down. But what Druckenmiller is saying with his trade, or at least from the commentary around his trade, is that he is short long duration. So there is always a possibility that short duration comes down while long duration debt goes up. So essentially, today, I think it's about 4.1, 4.2% on the 10-year. However, if in the future, if you didn't really like US debt as much, because you were worried about their fiscal irresponsibility and you were worried about their debts and their ability to pay their debts, you would potentially demand a higher interest rate in order to take that risk and buy long duration bonds off of the US. So his trade is essentially saying that he doesn't believe that people are going to pay super low rates for long duration US treasuries. And of course, that trade also encompasses the concern that we have another 1970s style inflation wave where there are multiple waves and inflation is very, very sticky and it comes back with a vengeance. So you've got that tail risk open, and then it's basically, hey, I think that the US is being fiscally irresponsible, so I'm betting that long duration interest rates are going to go up, which is entirely a possibility. Druckenmiller also mentioned that he is not interested in the China trade, however, likes Japan and Argentina. So likes emerging markets, doesn't trust China. That could be his influence from Soros. Soros was always very negative in when it came to China. So the two key moments there, shorting bonds, quite surprising. A lot of people were taken off guard by that, but he has been talking about this for quite some time, and then not keen on jumping into this China trade. So how is sticky inflation coming if demand is slowing and the economy isn't that strong? It comes from supply and speculation around future inflation. Geopolitical events can cause shocks. You know, you could easily get an oil shock if you saw oil fields being blown up and there being conflict in the Middle East that affected the supply of oil. Same with Russia, of course. So that's not demand-driven inflation. That's definitely supply-driven, and it's geopolitical in nature. Another interesting piece is that we've seen iron go up, I think, 26% or something over the last couple of weeks as the Chinese stimulus has started. Now, that isn't demand-based price increase. That is speculative price increase. That is the expectation that then will now be demand due to the fact that China is easing and they're basically stimulating their economy. We still haven't seen that follow through in demand. So we still don't know if that demand actually exists. And over the coming months, we will see if that actually turns around from a fundamental perspective. But the stimulus has been believed by the market. And on a relative basis, the Chinese equity market is very cheap compared to the US, as is basically any other market in the world, which ties into this last piece here, which has the S&P multiples. So the S&P at a 5770 or 5750 is between 28 and 29. The long-term median PE ratio on the S&P is 17, and that would put the S&P back down to 3,500. Can you imagine? And then if we were to see the multiple extend to a 32 PE ratio, which would be kind of all-time high, dot-com bubble-esque situation, you would look at an S&P of 6,500. So perhaps there's a blow-off top in the 6,000 to 6,500 range, but just bearing in mind that from a valuation perspective, the market, at least the S&P specifically, has basically never been this expensive. So that's how we're going to end today, going from inflation to the labor market, back to inflation, and then into S&P multiples. As always, this podcast is for information and entertainment purposes only. There are no buy, sell, or hold recommendations of any investment or security in this podcast, and none of this is personalized financial advice. We look forward to hearing from you, and we look forward to releasing more podcasts in the future. Have a great week, everyone. Goodbye.